this is a true 45-degree offset. If you have a plastic one at home, you might be able to overlay it, although depending on the aspect ratio of your computer screen, it may not exactly be 45. But on mine, it certainly is. And it shows me that we are breaking out of a 45-degree offset angle to this last axis here. And that's pretty much the equivalent of a normal 45 that you might have drawn down here. As a matter of fact, I can do that because these ensign ones show you the angle. And we can see that the normal 45 degrees is right about here. That's where this little consolidation is. So most people who had a 45-degree angle would be looking for it to break out of here. But I show the early breakout over here. So I would be inclined to go long as soon as they got above here. And this would be a valid buy signal down here because it did work. And in no case would I ever want it to get under, this buy area again. If I had bought somewhere in here or anywhere above this 45, ideally on a pullback bar somewhere in here, I certainly would never want it to get under the buy signal level right there. So the question now becomes is, what kind of an angular advance may I see? Should I use a stop loss? Do I want to use the width of a bar here that I can measure for a stop? Do I want to use the second bar back and just keep gradually moving it up? But initially, because there's always a steep momentum move, I want to use angles to tell me, give it a little bit of breathing room. Remember, our initial stop is only big because we don't know if there's going to be a secondary plunge. For instance, over here, you might get a plunge and you might have to be stopped out. But once you get into a good, strong move, you want to give it a little breathing room, but then you want to move your stop up at least to your cost. So you'll never lose money on the trade, but since you're not going to lose money on the trade, you want it to run a little bit, and maybe a 1% stop is too small. Maybe you need a 2 or 3% stop on profits, not on your cost. Once you're above cost and going up, never ever lose money on the trade. But then your stop can be a little bit bigger if you're just playing with profits. So what I'll often do is take an angle now and do an offset angle to this 45. Now in some cases, since we don't have this data yet, if we're basically in a position where we're over like this and we want to draw an angle, unless we have a lot of white space on our chart, and you may or may not be able to on your computing software have white space like that, what you can do is you can take a 45 like this and you can move it around, which is what I've done over here. You can offset this. So let me just show you what I've done. I'm going to get rid of this one. I can just take this angle right here and I'll move it over here to the left anywhere. It doesn't matter where it is. And now what I'm going to do is I'm going to go back, draw a line, and I'm going to overlay. What you can't see again is along the side of this axis of 45 slope, I now have my 60-degree plastic triangle. And what I'm doing, this is a 60-degree angle that I'm drawing right now that is offset from this 45. So then what we can do is we can go back over here again, drag our angle over like this, and we can drag this over. And we can then take our 60-degree and attach it to our low to kind of find out what kind of momentum this thing would have. And as we move it forward, we can see that it does a pretty good job of keeping us in the trend of a strong move. If it starts breaking under this, of course, we'd be stopped out. And in all truth, I probably would have taken a profit up in here. As soon as I got in, there was no overlap on the bar. There was almost no overlap on the bar, showing a lot of strength. No overlap. Here's more than a 50%, but there's no further advance. So after 3 days in a row, no further advance. We get a little sell signal here, but it's a double bottom. By the third bar, I'd be out of this trade anyway. And I'd be either waiting to get a pullback. In this case, we know it's going to pull back into our area. Old highs here becomes future lows. And we also, if it didn't get that low, I would be forced to get in as soon as it went to a new high anyway. One thing I would not be doing, getting here, is on a steep angle advance, is doubling up and going short. Remember, we only want to short the patterns that are going steeply down and they're in existing downtrends. If we have hopes that this is a double, triple bottom and this is some kind of an uptrend now, there's going to be a series of angles it may pull back to. But it's going to be really a long time before it loses enough momentum here of not making new highs before it really is positioned again to really start going down. Once we have a series of lower lows, lower highs, lower lows, lower highs, and this may take several days, then we'll think about shorting. But initially, as long as we have a nice steep angular advance, all we want to do is take a profit on the sell signal, look to regroup, position again. Even here it's a wide bar, but this would be your buy signal again right here. And continue on up as long as we're here. Every time you get a sell signal, maybe you could scalp out, try and better your position by 2 or 3 points, get in again, take it up to the next sell signal, scalp out, and keep this on up until, especially when you get to a point where you've lost all momentum, when you suddenly find that you're going 2, 3, 4, 5, 6 hours and there's no more movement. This is the case where when in doubt, get out. So basically, think about using offset angles. If you can't draw them, remember, you can always move your chart screen and move these angles around. You can also have these angles pre-drawn on your charts, going both up and down. So you can have them on your chart, and whenever new territory comes up, for instance, over here, we can just attach it to this low. And we can see how it reacts when it gets to the 60 degree. And we can see how the 45 degree over here off a low, but that one, we did that one before. But we could do it from the secondary bottom. And from the first bottom, we drew it to the top. So from the second bottom here would be a good sign of weakness by using these pre-drawn 45s and 60 degree offset angles. Let's do a quick review now of some of the principles and some of the tools that we've learned about in this video. The first one is the use of angles, and usually when we use angles, we use the principle of doubling. So I've started off showing you that one of the best ways to set up your time and price grids so the angles work fairly well is to set up the 4x1 angle as the initial run. And the first top of the 4x1, of course, is 100%. So that is a price unit. 100% of the price unit will be your first top, and 100% of the time unit will be the level from the start of the low to the first top. If we put our 4x1 angle there, and then double that angle, we'll get the 2x1, and we double that amount again, we'll get our key 1x1 45 degree angle. And we only want to buy things that are above the 1x1 and preferably going up slopes of the 4x1 or 2x1 angles. When we do this, we find out that usually when they break an angle, they will go to the next angle, but they'll also be at key support and resistance on our angle. And so it gives us great reliability when they break and they go down to the next angle. We have both a support level and an angle level, and that usually coincides with the time cycle. This is a big help to us. If you use your own types of angles that you've trend fitted to your chart, always try and have them or double them to find other angles that will also work with that particular chart. Along with the doubling of our angles, we find that the prices often double also. As we've just seen, if we use the high of the low bar, the initial DNA, so to speak, of an up move, that will often give you multiples of that as targets. So here in red, I've taken the first distance, then I've doubled it, then I've doubled it again, doubled it, and then after that, doubled it, and then doubled it. The last doubling is off the page, and the midpoint is the all-time high. Then I've also tried here using the first swing to the first top. You notice that's in blue. And then I took the first swing and doubled that. That gave me these intermediate term lows. Doubling that gave me the exact high, and doubled that again, where it came out to be the major consolidation pattern for a while. But if you note that these are all very precise, they do work. They're all based on the initial bar. Now, of course, if you have an oddball bar down here, it may be hard to fit it. That's why I've used the initial impulse wave as also a second approach to the doubling. But keep in mind that each target will get progressively bigger and bigger within the framework of the overall pattern. Now we always want to try and put both our angles and our price levels together, because time and price run together in the chart pattern. So after we take our initial doubling areas and we come up with our grid box for our angles, we will find that if done properly at the major significant highs and lows, you will be on an angle at a resistance area and at a time zone. And once you see that at the time cycle is up and you're at support or resistance on an angle, then you would get your best trades, and they would usually reverse and go back down to the next support or the next angle. And so we see that in this chart of Caterpillar here, that as we went into the 2x1 and it rested on it, then at the 1x1 time zone, it was resting on the 2x1 angle at our doubling resistance area. Then the next midpoint, it was hit on an angle, so it basically consolidated. And as the time cycle came out, the second big time cycle, it went up to hit the doubling area again, right on a trend line. So this is a good way to see that the time and price elements are lined up properly. And when they do line up that way, they have a much better forecasting abilities, and we can make better assumptions about what's happening in the future. So using these ideas, we can come up with a very simple trading strategy. One might be to identify the low of the high bar and use our measuring device here to double it and then double it again and then double it again. And on the initial breakaway, perhaps we either bought it on a big wide-ranging bar getting away from the high of the low bar buy signal, or if it gets away from us one measured move at this first red level, we'll wait for any kind of a dip back to the 50% of the two levels, because most of the time they will pull back towards that 50%. And that's where we can enter safely and have a stop under the low of the high bar if they break under that. Then once they exceed this first doubling level, they will go to the next target most of the time. And that would be an area where we could either scalp out a profit, or if it's very powerful, we may hold on with a trailing stop. But usually I'll scalp out a profit there and then patiently wait to see if it's going to consolidate and go up, or if it does consolidate and come down, it will usually pull back to the 50% point again. And that's where we re-enter the trade for the next leg up. Now, in this case, it went up, and this red level, remember, is a midpoint. It's not a doubling. When we double this 50% level here, it goes up to this top. And so that's why we had a little consolidation here, and the actual target of the doubling was up in this area. So we'll see on this next day of this particular chart, the follow-through to it. This was that midpoint right here. It actually did get to our target zone, where you could have sold out here or up in here. And then it bounced around for a while and did not really take out any highs. But then it did have a plunge where it came right back down to our ideal buy point again at the 50% mark between the two levels. So at this point, we'd re-enter the trade again on the first little buy signal that we see, the high of the low bar. You can also incorporate into your strategies this slope principle I've mentioned. After we take the low of the high of the low bar here and we start doubling it to get our potential targets, and we go up to these target areas and break, we can take our first major impulse wave and put on our slope, and then keep dragging over that identical slope under each of the subsequent highs and lows. And usually the market will trend up until that slope is broken. Here it almost hit our doubling target again. When it comes down in a pattern like this, where it's been in a downtrend already and it breaks the slope, then it will usually pull back to the full midpoint again. And at that point we can have another angle coming up to give us an idea of how long it could last. As long as it's above that slope, we stay long, and we liquidate as it starts to break under that slope. Now, in long-term swings, perhaps we'll use